Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money, your weekly personal finance date with me, Surabhi Upadhyay. Well, the budget is upon us. And like every year, the market and investors are wondering if the finance minister can come up with some sort of a magic formula that charges up sentiment and gives the bulls a new lease of life. Now, last year, we've already seen lots of major changes, actually, a big overhaul of the capital gains regime, for instance. We've also seen significant income tax cuts, especially, of course, in the new default income tax regime. So should we really expect any major changes in personal taxation at all? And how can this budget perhaps impact we, the common people of India, when it comes to our wealth creation journey? Well, joining me to answer those questions are Rahul Jain of Nuvama and Amarpal Chadha of EY. Gentlemen, thank you so much for joining in. At the outset, I want to start by putting in a caveat. No, we didn't plan this. All of us are in black and white. This is not a hint or a sign, and it was not planned. But I don't know. Gentlemen, so is it going to be, I don't know, black letter day? I hope not for the market and for
black
investors.
Black is lucky for me, Surabhi,
Oh, black is lucky for Rahul.
Yeah.
Amarpal, what do you think? Black budget, blue budget, red budget, green budget? What will it be?
I think the coincidences are always good. So let's hope the same thing happens on the budget day.
True. Well said. So, gentlemen, the whole idea is to kind of, rewind, take a step back, rewind and prepare our viewers for what to expect on Feb 1 and if that really changes our life in terms of our investment journey and our tax planning journey. So, Amarpal, let's start right there. Like I said, and memory is still very fresh, right? Last year was a huge budget from the tax perspective. We saw so many changes in capital gains, so many changes in personal income tax. So just recap some of the big ones for us and tell us how are these changes progressing along? I mean, have they been well digested by taxpayers?
And as you rightly said, Surabhi, I think it was a very big year last time for the budget, especially for personal tax, and people were actually also not expecting something this big to come. To assume that the tax slabs will change in a manner that up to 12 lakh, there will be no tax and there will be a rebate available up to 12 lakhs. That was, I think, really amazing. People didn't expect that much. And that could be one reason why there is not so much on expectation and noise this year from a personal tax perspective. Also, a lot of cleanup on the capital gains taxation that happened last year, very clearly putting off 24 months and 12 months categories, saying, okay, if you are in equity, this is what's going to happen. If you have a property, you have a bullion, these are the standard rules of 24, 12 months. I think life became much more simpler after that. Also, the consumption of the default tax regime or the concessional tax regime really picked up in the last year. Now it's become like a no-brainer that people would generally be in the new tax regime or the default regime vis-a-vis the old regime. Unless somebody really has a lot of deductions available, it doesn't make any more sense. So I think great budget last year, and hence the lower expectations this year.
Okay, absolutely. So I think on the income tax front, I don't think anybody can go out and expect the finance minister to do more because it's already a stated, sense that lesser deductions move towards, a tax regime which has lower rates, which is what we've kind of seen in the past couple of years. But now I want to talk about capital gains, Rahul.
Yeah.
And that's a sore spot, right? First, the rate of tax went up from 10% long term, went to 12.5%. Then market didn't give much capital gain to begin with in the entire year. So when you've interacted with so many investors through the years, what is the feedback? This 12.5%, I mean, it's here, it's the law now, so we have to pay it. But is that kind of further souring sentiment at all?
So I would say that when someone is looking from long-term wealth creation and when they expect to make a double digit or 15% returns annually, I think that 2% does not make a big change or dent to their portfolio or thinking. And that's when you're making money. I think the soreness comes when end of the day you don't end up making money and then you start thinking about all things which are there.
Yeah.
So I think all this becomes a cost for investor in that sense. But I would also agree what you said and other gentlemen said that there's a lot of transformation which we did last year in terms of capital gain simplification. I would say that income tax cut, which no one expected, I thought was a big one. I would say this year can be a year where certain things can still get simplified. So I would bucket income tax in two parts: convenience and simplification, and the other could be parity in that sense. And there are areas which can be done. To just give you some perspective, like in a Cat 3 AIF, everything gets taxed at the fund level, and mostly funds are at the top slab. Now, if I am a Cat 3 investor, it's not a pass-through vehicle, and I have a 20% slab, for example, hypothetically, then I will get taxed at the full rate.
Okay.
But rest of the other AIFs are all taxed at the investor level. It's a pass-through mechanism. So if it brings confusion, complication, if someone has done Cat 3, Cat 2 both at the same point of time. And this can be a big simplification where it can also become a pass-through from Cat 3.
So basically you're saying that when it comes to category 3 AIFs, alternate investment funds, tax them like the other two categories, basically at the level of the investor.
Investor. Pass-through will be better, it will be convenient. Another thing is that a lot of investors, what I meet, they always try to switch from a dividend to growth scheme.
In a mutual fund.
In mutual funds or a regular to direct. These are not actually taking out the money or redeeming the money. It's like moving from one way to another, either for cost efficiency. From regular direct is cost efficiency effectively. Other is that I was taking dividend, now I want to do growth from wealth planning, long-term point of view.
Correct.
That also has a tax implication. So a lot of people are not able to take that decision that why should I pay tax now?
Because you have to remove the entire sum and then pay capital gains on it and then reinvest that money into a different option, for instance, a dividend option.
Exactly. And similarly, if you look at ULIPs, the movement of one fund to other is very easily available. So I think similarly things can be done here also from convenience point of view. From parity point of view, if you see, and if you look at from wealth, asset allocation is very critical from philosophy point of view. And every client has an equity need because they want growth. Every client has an annuity need because they need stability, predictability. And some gold for hedging, like you've seen what's happening.
Some gold, people want all gold and only gold now in their portfolio.
That's a big change which is happening now. But coming to my point of equity and debt, a lot of people are now getting into more equity-led schemes because they think that the difference between taxation is widened between debt and equity. What happens is that while it looks tax efficient, but equity also increases your risk from a profile point of view. For example, a 60-year-old plus, a lot of investors are plus 60. And they now generally tend towards getting more into equities because they find the tax very efficient. So we keep explaining that tax is secondary. First is risk and income.
Correct.
But somehow people move towards that direction.
Because tax, ends up driving our investment decisions, even when it shouldn't. Let me bring in Amarpal exactly on this point. Amarpal, now capital gains, right? And you've just heard it from Rahul. I mean, he helps people manage their money, but that's the fact of it. In an ideal world, tax shouldn't decide our choices, but it does because we want tax-efficient returns. So how do you rate and rank the overhauled capital gains tax regime? First of all, whatever the changes that were announced last year.
And Surabhi, that's a great point which Rahul made. I think we also need to understand the genesis was earlier in the old tax regime. You'll remember all our investments were governed by the fact that there was an ATC deduction available. People would put money into schemes to get deductions under Income Tax Act. So all that was a philosophy that was being taught through tax to people, isn't it? If you have to save money, put through tax, invest in these schemes. Luckily, with this new tax regime, which is the default regime now, this concept is going. Now people are free to take out their money and put where they would like to, whether it's an NPS or an open option or mutual fund. So it helps people to rethink, especially the younger generation would not get blocked by just the tax rates. And if you see the capital gain regime now, like what Rahul mentioned, some of these things, yes, as new products come, for example, a direct versus a mutual fund route, all of these are developments, isn't it? So tax laws need to live up to it. So some of these changes will come as industry comes with new products. So some clarification on these things definitely helpful. But I would say government is already on that path. These are more evolving discussions and products, which slowly would get clarified.
So on the point, Amarpal, of debt or fixed income specifically, I mean, that's the point that Rahul just made. that there still seems to be a big gap between equity taxation and fixed income taxation. There are very few avenues in which you can be in fixed income and yet have that be tax efficient. Most of it is just taxed at a slab rate, right, in interest income. Is there a case for the government to consider this and to consider changing this?
See, a lot of these discussions have happened in the past, and one reason for increasing the tax slabs, the threshold could be this. Because see, if you start giving specific exemptions, let's say for fixed income, for other aspects, it becomes then difficult to manage the whole scheme because the government is also moving a lot towards simplification. So hence, a slab increase is a better answer, and which the government done. So now you can go up to a very high income level, isn't it? As it's coming on the screen, you are up to 24 lakhs, you will not be at 30%. So even if you have fixed income and your income, let's say for a senior citizen, there is a fixed income which is below this threshold, you are still at a lower income. But yes, no comparison to the equity game, because in equity, you are getting higher returns and lower tax. So can a fixed income product be put pari passu with that? Is it something that can be done? I think it's a great idea. If there is some fixed income product which can get taxation of a long-term equity or a short-term also, it would be great. But currently, the law doesn't have any scope for that.
Yeah. Rahul, you think, there's a need to look at this here, because there was a point in time a couple of years ago where at least debt mutual funds had the benefit of indexation, and if you were holding for 3 years plus, you could enjoy more tax-efficient returns. All that is history now. So on the fixed income side, what are you, advising investors to do as of now?
So for us, like I said earlier also, that tax is secondary. First is managing your risk and your asset allocation well. That is the first and foremost advice. And now if you look at from debt point of view, another thing government has done there in last budgets is that having the same rates across different categories, or that at least that simplification has come into the play. The point what I was trying to say, and what the gentleman also said, is that equity makes higher returns and lower tax, but equity comes with higher risk as well. For us, it's important to know is that a good balance of risk from every client portfolio is very important and critical. He takes tax as one of the ways of looking of investing, and that is where the confusion comes into play, because the gap has widened.
Right.
So some reduction on the debt side, or bringing more simplification, more uniformity, or closure to equity can be one of the ways to solve this out. Otherwise, people will keep moving more towards equity.
More towards equity, whether their asset allocation really needs it or not.
And whether the risk decision is happening on the basis of tax.
Which is not the best way, perhaps.
Perhaps
take that point. Gentlemen, stay with those thoughts, because we have more to discuss. There's also property, where there was a change in taxation, and that benefit of indexation was taken away for some cases. So we'll go back and revise what the law says on that front. And then let's not forget this big gold rush which is on, gold and silver rush. So from a tax perspective, is there anything that we should be aware of? We'll be discussing this in just a moment.